Howdy everybody, welcome back to Accounting 1101. Your old pal Professor Martin here with you. In our video today, we're going to talk about inventory cost flows, and we're going to be looking at FIFO, first in, first out, and hopefully be able to work through an example that will prepare you for homework problems that you're going to see later on. And so if you're not familiar with FIFO, if I throw that out there and you're like, what am I talking about? Real quick, the game we're playing. And if you notice right there, I've got a screenshot or a photo here of some board games on display at Walmart. And that's the game we're playing here. We're playing board games. Business buys inventory and they stick it on the shelf. All right, that's kind of step one of this whole process. We have a cost in inventory. Inventory is sitting there on the shelf. And inventory kind of has two states that it can exist in. It can sell or it can sit, right? We buy inventory. In this case, we buy board games. We sit them on the shelf. Those board games can either sell and leave the store, or they can sit. If they sell, it becomes cost of goods sold. It becomes an expense. If they sit, well, just sitting in ending inventory. It never leaves that inventory balance. And so the game we're playing, when we talk about FIFO and LIFO and average, weighted average inventory and all that good stuff, the game we're playing is trying to allocate that cost of inventory between goods that sold and goods that sit in ending inventory. And like I said, FIFO, LIFO, weighted average are the methodologies we use to make that allocation. All right, so just to put some numbers in here. Let's say that we bought $100,000 in game board inventory. When we talk about allocating that $100,000, there's only two places it can be allocated. It can be allocated to cost of goods sold to represent goods that left the store, or it can be allocated to ending inventory, goods that are still sitting in inventory. And so if you think a step ahead here, our cost of goods sold and our ending inventory added together should equal that $100,000 that we started with, that we paid for the inventory. So whatever we paid for inventory eventually gets allocated to cost of goods sold for stuff that has been sold, or ending inventory for stuff that is still sitting in inventory. As I mentioned, FIFO, LIFO, weighted average are all methodologies that we're going to learn how to use. And to be honest with you, a company can use all three of them if they want to. It's not a one-shot deal where if you use FIFO, you can't use anything else. Companies can account for different types of inventory in different ways. And they have to disclose how they're accounting for the inventory, but there's nothing to say that Walmart couldn't account for their board game inventory using LIFO and their fuel inventory outside at the Walmart gas pump using weighted average or some other methodology. Okay, so I'm going to walk you through an example of FIFO in this video, and then we'll tackle LIFO, weighted average, in another video. So FIFO, again, first in, first out. We are making an accounting assumption that the first products in are the first ones to be sold. Now, that's an assumption. In reality, we don't really know the exact physical flow of inventory because all the individual items are the exact same. If you think about Walmart, you can see the Monopoly games here in one store. Maybe they've got 20 of them. Okay, well, if you take all the stores and all the warehouses and all the Sam's Clubs and add all those Monopoly games together, they may have literally tens of thousands of Monopoly games, all the exact same, all ordered at different times, all costing different amounts to Walmart. So, when I go in to buy one, maybe I pick up one that just sat on the shelf that day. All right? The physical flow is not the same necessarily as the assumption we're making. We're assuming that first one in is the first one out for cost purposes. So let's do an example here. I'll walk you through how to maybe put together a problem so you can figure out the cost of goods sold and ending inventory using FIFO. I've got a Monopoly board game up here. Monopoly at one point sold kind of a limited edition glass board Monopoly. You can see the whole thing's made of glass. They got fancy dollar bills, fancy little tokens here that you can move around the board and cards and all that stuff. I'm guessing that was a one-time use item. I don't know about you. every time I've ever played Monopoly, it didn't end with someone going bankrupt or some person winning. The game basically ends when somebody gets mad and just turns the whole game over and breaks it. And throws stuff everywhere. And so I'm guessing this is kind of a one-time use deal. But we're going to assume that's the product that we're dealing with here in inventory. I've given you some information about the beginning inventory. We got some sales in here. We've got some purchases, some more sales, and another purchase. We're going to use that information to figure up, as I mentioned, cost of goods sold and ending inventory using FIFO, first in, first out methodology. We're not going to wildcat it. As fun as that might be, we're going to use a template that I've put together. And I got this in Excel. We'll work through it, but I'm going to kind of show you what all is in the template. I've got an area to record purchases of inventory. I've got an area to record cost of goods sold. And I've got an area to record the inventory balance after every purchase or sale of inventory. And you can make this up on paper if you wanted to. I'm an Excel guy and a spreadsheet nerd, so I always do everything in Excel. And so that's where I'm going to do it. I'm going to provide you with the template, and I'm going to show you right now how we're going to use the template to do our problem. So let me go ahead and pull that up real quick. There we go, my inventory cost flow template. And you can see the exact same thing we just looked at. The only difference is I went ahead and copied the problem information here. That way we'd be able to see it without clicking back and forth. So here we go. How do we use a little template to figure out FIFO, cost of goods sold, and the inventory? We're just going to go ahead and start with our beginning inventory. January 1, we had 1,000 units. We paid $20 per. And so if I multiply that out, I get 20,000. I'm just going to go ahead and draw a line here. Make it nice and neat so I can tell where one part ends and the other begins. Real simple. Next up, January 4th, we sold 700 units. January 4th, we sold. So I'm going to put it under cost of goods sold. Now, don't get confused here. The $30 a unit sell price is quite inconsequential to what we're working with here. We don't care about what it sold for. Remember, we're tracking inventory cost. That's the game we're playing. Doesn't matter what it sold for. And so don't get confused and put that sell price in unit cost. The unit cost is what we had paid for the inventory. Now you see we sold 700. We had 1,000 in inventory that we paid 20 bucks a piece for. So that unit cost is going to be 20. So my total cost of goods sold on that transaction is 14,000. Now, what's my new inventory balance? Well, I had 1,000. I sold 700 of them. 300 left. And I had paid 20 bucks a piece for the 300. So my ending inventory balance, 6,000. Okay? So that's kind of what we're doing here. And we'll see as we add inventory in and sell more inventory that we kind of have to start thinking about, okay, where am I pulling this inventory from? And that's where the FIFO and LIFO really comes into play. Right now, I didn't have to think much about it because we had one sale and we just pulled them all out of one layer of inventory there. But it'll get a little bit more complicated here as we go along. Okay, so I'm going to go ahead and put a line under January 4th right there. Next up, January 10th, we are buying inventory. We bought 500 at a cost of $22.40. Nothing was sold, so I'm going to leave that part blank. I'm going to come over here to my inventory balance. Here's a really easy place to booger things up. And people get stuff wrong on FIFO, LIFO. This is normally where it happens, at least a lot of time where it happens. I have a beginning layer of 300. That layer is still there. Right? It didn't go anywhere. Now I'm adding a layer of 500 at $22.40. Everybody kind of see what happened there? So now there's my beginning layer. There's my new layer. When you do these problems, y'all, it's very important that you keep your layers in the correct order. And what I mean by that is don't put the new layer on the top. All right, put the new layer there on the bottom. You see what I'm saying? So let's go ahead and kind of underline that right there. Right now I have $17,200 in inventory. $17,200 in ending inventory. 300 at 20, 500 at 22.40. All right, so that was our January 10th activity. On January 22nd, we sold 360. Here we go. January 22nd, we sold 360. Now, here's where FIFO LIFO comes into play. We sold 360. We got to figure out where to pull them from out of our layers of inventory. And again, when I say where to pull them from, we're not talking about the physical item. The physical item, we have no clue. We're talking about pulling cost. We're making an assumption here. First in are the first out. So I sold 360. That means that entire layer right there, if I'm doing FIFO, is going to go away. Because FIFO, we're pulling the first ones. So I pull 300 out of that layer. $6,000 cost of goods sold. But I still have 60 more, right? I haven't pulled all that I needed to pull. I got 60 more to pull. So that additional 60 is going to have to come out of my layer of 500. 60 at 22.40. There we go, 13.44. So that's how FIFO is applied. I sold 360. That entire layer of 300 is now gone. So I have 0 at 20. 0 times anything is going to be 0. I took 60 out of that layer of 500. So now I have 440 at 22.40. Multiply that out. I now have $9,856 in ending inventory. You see the game we're playing? I'm taking that inventory cost of what I paid for the inventory. I'm splitting it between cost of goods sold and ending inventory. All right? With me? Let's move on. January 28th. We sold some more. This time we sold 240. I don't have to think too much about splitting because I only have one layer of inventory right here. I have a layer at 22.40. Get rid of those decimal places. So I had 440. I sold 240. I have 200 remaining at a cost of 22.40. So now I have 4,480 in ending inventory. We are running low on glass Monopoly board games. We better order some more. And that's exactly what we did on January 30th. We bought 600 more at a cost per unit of $23.30. Multiply that out, I get 13,980. Nothing in cost of goods sold right there. Now we have a layer of 200 at 22.40. And we have a layer of 600 at 23.30. All right. So there we go. That's how we do FIFO. Now let's talk about figuring up cost of goods sold and ending inventory. Every time we sold, I calculated a total cost of the inventory that was sold. Walk through that with me. So our total cost of goods sold is going to be about 14,000, 6,000, 13.44, and 53.76. So my total is going to be 26,720. That's my cost of goods sold. I come back over here, my ending inventory is simply these two layers right there. My layer of 200, my layer of 600. So that's it. That's how we use FIFO to calculate cost of goods sold and ending inventory. Now, I mentioned earlier in the lecture, I said that total inventory cost, what we paid for it, is allocated to cost of goods sold, stuff that left, and ending inventory, stuff that is still on the shelf. And so we see we got cost of goods sold, we see we got inventory balance. If I add those two together, cost of goods sold, my ending inventory, I get 45,180, right? I had 20,000 bucks in my beginning inventory, meaning I had bought 20,000 bucks worth of inventory. I bought 11,200. I bought 13,980. Let's add those numbers up. I began with 20,000. I'd paid 20,000 for the beginning inventory. I bought 11,200 more. I bought 13,980 more. I bought in total 45,180 in inventory. What we did using FIFO is we allocated that amount we paid for inventory to cost of goods sold and ending inventory. Neat how that works out, huh? Now, one other thing I want to throw in there. You've heard me say multiple times about how inventory can either sell or it can sit. You remember back when we talked about shrinkage in our last unit, we talked about inventory disappearing, and that gets included in cost of goods sold. And so I just want to clarify that point real quick. I wasn't lying, that also gets included in cost of goods sold as well, but we just kind of dump it in cost of goods sold. So that's it, that's FIFO. Couple of points to kind of hammer home here before we turn off for this video. During inflationary periods, which is pretty much all the time, costs are always going up as businesses buy their inventory. But during an inflationary period, FIFO leads to a lower cost of goods sold because the first products in had a lower cost than the newer ones because costs keep going up. The flip side of that coin, FIFO will lead to a higher ending inventory balance than LIFO or weighted average because the newer goods, the higher cost goods, are unsold and sit on the shelf. Now again, I'm not talking about physical units. We're just talking about an accounting assumption here. So that is FIFO. We're going to come back and do LIFO in our next video and use the exact same template, the exact same example, and show you how to work through LIFO. If you have any questions in using that template or as you're working through your homework, I'd be happy to help. Feel free to reach out and we'll talk FIFO and LIFO all you want to. Until next time, take care, everybody.